So it's January 18th, 2026. And I'm looking at this stack of reports on my desk, and honestly, I'm getting a bit of whiplash. Do you remember the whole crypto bro
Oh,
era?
hard to forget. It was loud.
So loud, all laser eyes, dog coins, the Super Bowl ads, just this frantic gambling energy. But reading these reports today from BDO, A16s, the regulators, the silence is almost deafening. It feels like the casino's closed.
The casino is closed and the architects have moved in. I think that's the perfect theme for what we're looking at today. If 2021 was the Wild West, 2026 is it's the year of city planning. Less exciting for the gamblers, maybe, but infinitely more important for the actual economy.
Right. So that's our mission for this deep dive. We're exploring what people are calling the Great Convergence. We're looking at how TradFi, the suits, and crypto, the hoodies, have pretty much merged. And to do that, we're pulling apart BDO's 2026 FinTech predictions, the huge State of Crypto report from A16s, and the actual text of the Genius Act.
And we've got some really fascinating market data on XRP, some big moves from Stripe and Block, and a look at this sort of no KYC rebellion that's still happening on the fringes.
Exactly. We need to figure out why everyone's suddenly calling 2026 the year of stablecoin utility and agentic AI. And I think ultimately we have to answer this pretty scary question that one of these reports posed. What happens when the internet stops just supporting the bank and actually becomes the bank?
It's a shift that, it changes everything.
Let's start with that foundation. For years, the biggest complaint from anyone serious in the space was, we just don't know the rules. The SEC might sue you, but they wouldn't tell you how to comply. But looking at this BDO report, that excuse is just dead now. What changed?
The Genius Act.
Ah.
July 2025. That was it.
Guiding and establishing national innovation for U.S. stablecoins. It's a mouthful.
It really is. But names aside, this was the watershed moment. Before this, if you held a stablecoin like, say, USDC, you were technically holding a crypto asset. It was ambiguous. The Genius Act reclassified payment stablecoins as regulated payment instruments.
Okay, so break that down for me. What does that actually mean for us?
It means legally, a stablecoin is now closer to a cashier's check or maybe a prepaid debit card than it is to Bitcoin. But the real game changer wasn't even the definition, it was the reserve requirement.
The 100% reserve rule, this is it.
Exactly. And this is so crucial because, banks operate on fractional reserves. You put $100 in the bank, they lend out 90 of it. If everyone wants their money back at once, the bank collapses.
Right.
The Genius Act mandated that stablecoin issuers have to hold 100% of the value in superliquid assets. We're talking cash. U.S. Treasuries.
So if there are 50 billion digital dollars out there, there has to be 50 billion actual dollars sitting in a vault somewhere getting audited every month.
Correct. No more commercial paper or, mysterious IOUs from sister companies. And crucially, the act gave all of us a guaranteed statutory right to one-to-one redemption. You give them the token, they have to give you the dollar.
Which basically kills the fear of a bank run on stablecoins.
It does. And once you take away that catastrophic risk premium, all of a sudden the CFOs at Fortune 500 companies can get comfortable. They couldn't touch something that might lose its peg. Now, it's just a digital dollar.
And this isn't just a U.S. thing, is it? I'm looking at the global map in the A16's report, and this whole thing looks coordinated.
It's the regulatory moat. You've got MiCA, fully live over in Europe, which, by the way, draws very sharp lines between different types of tokens. You've got the UK, Singapore, Japan, the UAE. All of them are enforcing similar full reserve standards.
So the whole world basically just agreed, okay, fine, you can have your digital money, but you've got to prove you actually have the money.
Precisely. And that's safety. That's what allowed the volume to just explode. Which brings us to that number in the A16's year report that made me spill my coffee.
I was waiting for you to bring this up. The volume statistic.
$46 trillion.
46 trillion with the T.
That's the estimated settlement volume for stablecoins in 2025. Just to put that into perspective for you, that is about 20 times the volume of PayPal. It's actually getting close to the annual volume of Visa.
Wait, hold on a second. Visa is everywhere. Everyone I know uses it every single day. I don't know a single person who pays for coffee with USDC. Where is this $46 trillion coming from?
See, that's the big misconception. This isn't about buying coffee. Well, not yet. This is about wholesale money movement. This is business-to-business, cross-border payments. It's internal treasury management for huge corporations.
Ah, so it's the plumbing. It's the stuff behind the walls.
Right. Just think about the old way. A company in New York wants to send $10 million to a supplier in Vietnam. It goes through SWIFT, takes 3 days, it bounces between 4 different correspondent banks, and every single one takes a cut. It's slow, it's expensive, and you have no idea where your money is.
And with stablecoins.
It's like an email. You attach the money, you hit send, and it settles in 4 seconds. For a fraction of a cent. That 46 trillion is the sound of global business waking up and realizing the old banking rails are, well, a total ripoff.
And this must be what explains the strategy shift we're seeing from the big fintechs. We've got news here from Stripe and Circle. It doesn't seem like they're just partnering with crypto anymore.
Oh no, they are becoming the crypto infrastructure. Look at Stripe. They didn't just add a pay with crypto button. They launched Stripe Tempo, their own layer 1 blockchain. And they went and bought a stablecoin startup called Bridge for $1.1 billion.
$1 billion for a startup. That seems aggressive. Why do that?
Because Stripe realized that relying on Visa and MasterCard and SWIFT is, for them, a negative-sum game. Those old networks have legacy costs they can't get rid of. By building Tempo, Stripe is building its own highway where they own the tolls, and the tolls are practically zero.
This sounds like that concept I-16Cs talks about, the stablecoin sandwich. I have to say, I love that visual.
It's the perfect way to explain it to someone who's skeptical. So, in a stablecoin sandwich, the bread is just normal fiat currency. The sender has dollars, the receiver wants euros.
Okay, simple enough.
The meat in the middle, that's the stablecoin. The user hits send. The dollars instantly convert to USDC, they zip across the blockchain to Europe, and then instantly convert to euros on the other side. The user never even holds the crypto. They don't have a wallet, they don't have to worry about private keys.
They just know the money got there instantly?
Exactly. The crypto part becomes invisible. It's just the transport layer.
But A16s points out another trend that's a bit more technical, but it sounds really important. Origination versus tokenization. They seem pretty critical of how things have been done.
Yeah, this is a really subtle but massive shift. For the past few years, all the hype was around real-world assets, or RWA. The idea was, let's take this paper bond and just make a digital token that represents it.
Kind of like making a PDF of a paper contract.
That is the perfect analogy. Tokenization is like a PDF. It's digital, sure, but if you want to change the terms, you have to go all the way back to the paper source, change it there, and then rescan it. It's clunky. You still have all that back office drag.
And origination is different.
Origination is like a Google Doc. The document is born digital, it lives in the cloud, you edit it in real time. What Epstein is saying is that in 2026, we're going to stop seeing tokenized loans and start seeing loans that are actually originated on the blockchain. The smart contract is the loan. It automatically calculates interest, automatically collects payments.
So you basically fire the back office.
You reduce the cost of servicing that loan by 90%. That's why the banks are so interested. It's not about being cool, it's about margin.
Speaking of margin, let's bring this down to Main Street. We have a press release here from Block, the company we used to call Square. They're rolling out Square Bitcoin for their merchants.
And this is fascinating because it's targeted right at the coffee shop, the small boutique, the plumber.
The feature lets merchants automatically convert a percentage of their daily card sales into Bitcoin. And Block is waiving all the fees until 2027.
It's a very, very aggressive move. Think about the psychology here. A small business owner, they operate on razor-thin margins.
Yeah.
They're terrified of inflation eating away at their cash. Square is essentially putting a hedge inflation button right on their cash register.
It treats Bitcoin not as a lottery ticket, but as a treasury asset, like a savings account.
And by baking it right into the point-of-sale system, they remove all the friction. You don't need a separate Coinbase account. You don't need to understand cold storage. You toggle a switch.
But this is where it starts to get a little sci-fi. While humans are toggling switches to save in Bitcoin, the BDO report suggests that pretty soon humans might not be the ones pushing the buttons at all, this agentic AI.
This is the trend that I think is going to define the next decade, easily.
We've had chatbots for a while. You know, I asked ChatGPT a question, it gives me an answer. How is an agent any different?
A chatbot talks. An agent does.
Okay, give me an example.
All right, so imagine you want to lower your monthly expenses. Today, you'd ask a chatbot, hey, how do I lower my cable bill? And it would spit out a script for you to read to the cable company.
Right, yeah.
In 2026, you just tell your AI agent, lower my cable bill. The agent has access to your bank account, your emails. It logs into the Comcast portal. It starts a chat with their support bot. It negotiates a discount based on competitor pricing it just looked up. It authorizes the new rate, and it just sends you a notification. Done. I saved you $40 a month.
Oh, that sounds incredible, but also A little terrifying. You're giving an AI access to your actual money.
And that is the risk. BDO calls it the alignment problem. What if your agent decides to move your savings into some high-yield account that turns out to be a Ponzi scheme just because the math looked good on paper?
Or what if it buys $1,000 worth of digital cat pictures because it hallucinated that they were a stable asset?
Exactly. And that's why BDO is highlighting this massive need for clean API layers and explainable decision logs. If the AI moves a single cent, there has to be a digital paper trail that a human can audit. We're about to see a huge industry pop up just to build guardrails for these financial bots.
But we're moving from managing our finances to managing the robot that manages our finances.
It's a promotion, really. You get to be the CEO of your life. The AI is your CFO.
I like that framing. Let's shift to market dynamics, because all this regulatory clarity and new tech is clearly driving a frenzy in the boardroom, M&A mergers and acquisitions.
The BDO report is predicting a huge surge in deals for the first half of 2026. And it's a two-way street. You have traditional banks buying crypto firms to get their hands on that origination tech we were talking about. And you have crypto firms buying banks to get their licenses.
But there's a catch, isn't there? The sponsor banks.
Oh, it's a massive catch. Sponsor banks, those smaller banks that kind of rent their charters out to FinTech apps, they got hammered by regulators in 24 and 25. They just got lazy with compliance. So now they are cracking down hard.
So if you're a FinTech startup and you want to get acquired, the bar is suddenly way higher.
Much higher. They want to see real-time AML, anti-money laundering. They don't want to report a week later saying you caught the bad guy. They want to see that your tech stopped the transaction before it even settled.
Which brings us to a specific asset that kind of lives right in the middle of this whole banking world, XRP.
The most polarizing asset in all of crypto.
Always. We have a prediction here from Standard Chartered that XRP could hit $8 by the end of 2026. But I'm looking at charts today. It's hovering around, what, $1.90? That's more than a 4x jump. Is that realistic, or is that just banking hype?
It's aggressive, for sure. But you have to look at the flows. We've seen 30 straight days of inflows into the XRT ETS, over $1.15 billion. That is institutional money. That is not retail traders on Reddit.
So the big institutions are betting on the long game.
They're betting that XRP is going to be the liquidity bridge for all that cross-border volume we talked about.
Yeah.
If stablecoins are the cars, they're betting XRP is the gasoline.
But then the technical analysis suggests it could drop to $1.25 first. It feels like the market just has not decided if XRP is the future or if it's a relic.
It's the classic tension. High utility, but a huge supply and a lot of historical baggage.
Speaking of tension, let's talk about the complete opposite of the institutional, super compliant XRP world. Let's talk about Digitap.
It's the rebels.
This project, ticker TAP, it calls itself an omnibank, but the headline feature is no KYC Visa cards.
Which, if you've been listening for the last 10 minutes, should sound pretty much impossible.
Exactly. We just talked about the Genius Act, 100% reserves, AML crackdowns, total transparency. And here's a project saying, here's a debit card. We don't need to know who you are. How does that even exist?
It exists in the gray areas. They probably use offshore jurisdictions or loop through a bunch of different intermediaries. But it just highlights that the cypherpunk ethos, that desire for real privacy, it hasn't gone away.
But isn't this just a massive blinking target for regulators?
It's a walking target. But the demand is undeniable. There are millions of people who want to spend their crypto without Big Brother watching every transaction. Digitap is betting that that demand is stronger than the regulatory enforcement will be.
It really feels like a collision course. You've got the clean city of the Genius Act, and then you've got the underground of no KYC. And it seems like 2026 is the year those two worlds are going to crash right into each other.
And, well, usually the city wins. But the underground never really disappears.
Let's wrap up with one last concept. Tokenization of wealth. We've talked about lending, but what about investing?
Right. This is the democratization promise. The idea that you shouldn't need a net worth of $10 million to invest in private equity or a commercial office building.
You just buy a token that represents a tiny share of the building.
But E16s, that kind of throws some shade here. They call the current approach skeuomorphic.
I love that word. It means designing a digital thing to look like its old physical counterpart, like the little trash can icon on your desktop.
Exactly. And A16s is saying that just making a digital token that acts exactly like a paper stock certificate is, well, it's boring. It's skeuomorphic. The future isn't digital shares. It's crypto-native derivatives.
Okay, you have to unpack that one for me.
Think about perpetual futures. or CURPS.
Yeah.
In crypto, you can trade the price action of Bitcoin without ever owning Bitcoin, and the contract never expires.
Okay, I'm with you.
A16s is predicting we're going to see perps on real-world assets. So instead of buying a tokenized share of a house in Miami, which still involves deeds and legal paperwork and all that, you just trade a perpetual contract that's tracked to the Miami Housing Index for that specific zip code.
So you get all the financial exposure without any of the heavy lifting of actual ownership.
It completely changes the physics of the market. It makes something like real estate totally liquid.
Yeah.
You could, in theory, day trade the housing market.
Which is both incredibly exciting and potentially disastrous for stability, but that is a topic for a whole other deep dive.
Yes, it is.
So let's try to synthesize all this. We're here in 2026. The plumbing has been completely ripped out and replaced. We have the Genius Act providing the blueprint. We have $46 trillion flowing through stablecoins. Stripe and Circle are becoming the new Visa and MasterCard. And these AI agents are kind of warming up in the bullpen, ready to manage it all for us.
It's the hidden upgrade.
Yeah.
The user interface of money, it hasn't changed that much. You still tap a card, you click a button. But everything that happens after that click is a whole different world.
It brings us right back to that provocative thought from the A16's report you mentioned at the very beginning.
Yes, and this is what I really want you to chew on. We tend to think of FinTech as tech that helps banks. We think the bank is the center of the financial universe.
Right.
But if money just becomes a data packet like an email, and the internet can route that packet instantly, programmably, and securely,
Then the internet doesn't just support the financial system.
the internet becomes the financial system.
And if that happens, if your AI agent holds your wallet, negotiates your bills, and executes payments on a blockchain without you ever even touching a banking app,
Then you have to ask yourself a very serious question. Is a bank account something you actually need? Or is it just an app on your phone that you haven't gotten around to deleting yet?
that is a massive question. We're going to leave you there to think about that. Thanks for diving deep with us into the brave new world of 2026 finance.
Always a pleasure to inspect the plumbing.
Catch you on the next Deep Dive.